Good morning, guys. It's a wonderful morning. We want to continue our study on the standards, and we want to look at financial instruments. All right, financial instrument. Financial instruments has plenty standards embodying it. Okay. We have IAS 32 is there, IFRS 7 is there, IFRS 9 is there. All right, these are three standards that are embodying financial instruments. So the IAS 32 talks about presentation, all right, financial instrument presentation. And we have the IFRS 7, which actually talks about disclosures, right? Then we have the IFRS 9, which talks about the recognition and measurement. But for those of us doing FR, this is the part that we are supposed to go through. All right. So that is the part your syllabus wants start to actually go into and deal with. Okay. Yeah, so that is that. Now, what is a financial instrument? Financial instrument, we will say is, one of the standards that creates confusion for students, and how to go around it has been a very serious stuff. But the way I want you to approach it is having the fundamentals of accounting. Do you remember asset is equal to capital plus liability? And this capital is what we call equity, all right? Okay, so that is that. And if you want this equity, then it means you need to kind of do a change of subject here. So it will become asset minus liability is equal to equity, all right? And this is the foundation I want you to have, okay? And so we say a financial instrument is actually any contract. It's any contract that give rise to a financial asset of one entity and financial liability or equity instrument to another entity. All right, so that is the definition for it. We will come to the recognition and the measurement later, because here you will see that there are three things being mentioned here: a financial asset, a financial liability, and an equity instrument. So you need to, separate these things and give each one and its recognition. Okay, we all know how currencies have been faring these days, and there has been a huge significant growth about the concept of financial instruments, especially in the market of derivatives. All right. We are not supposed to go into details as FR people, but if you later do corporate reporting, you will see that you will have to go into details and deal with hedges and all those things. All right. But here, this is what we are supposed to know. So there is a financial asset, financial liability, and equity. And this is what we are trying to say. So it's kind of a contract. You have a party A and a party B. All right. If the contract in between here, all right, give rise to a financial asset to one of these entities, it will definitely give a financial liability and or, all right, equity instrument. All right. So that is how it is here. Now you can see that, for example, if you have, let's say, a receivable in your books, it is a financial asset to this person. However, to the other party, it is a payable, all right, which is a financial liability. Okay, so that is how it is, the double entry of it. But not all current assets are financial instruments, all right? Not all of them are financial instruments. Okay, so if you have something that gives rise to asset here and an asset there, it is not a financial instrument, all right? So it has to be an asset to one, a financial liability, or an equity instrument, all right? So that is what we are trying to say. All right, so that is it. Sometimes it may fall within the two, that is it. All right, so if you have that, then that is your point. That what I'm going to do is that I'm going to create a new board here and split them into 3. And I'm going to use that to actually discuss these financial assets and all. All right. So I'm going to split my board into 3 and tackle those 3 components of a financial instrument that we just saw. So here, I want to talk about I'm going to talk about financial assets. I'll talk about equity instruments. Here will be for financial liability. Okay. So that is that. And we are going to use these parts to explain each and every component of it. All right. So what is a financial asset? Financial asset is any asset that is cash. All right. Any asset that is cash is a financial asset, or a contractual right to receive cash. Okay. A contractual right, like the receivable, to receive cash, or another financial asset, okay, from another entity. Okay, so either you have the cash or you have a contractual right to receive. Not only that, if you also have a contractual right to actually exchange a financial asset or a financial liability with another entity, Okay, and a potentially favorable condition, then that one to potentially favorable condition. Okay, so it favors you, all right? That is it. And the last bit is that an equity instrument of another entity is also a financial asset. Equity instrument of another entity. Okay, so what they hold it in you, you have a financial asset. To them, they have a financial investment. All right, so that is that. A typical example of what a financial asset as defined by IAS 32, we have like trade receivables. I mentioned that. Cash is cash, you can see that. And this contractual right is what actually gives us trade receivable. The right to exchange, so that one is options. Options, loans, and this one explains investment in equity shares. All right, so that is a financial asset. All right, that is a financial asset. Now, what is equity? And most of the time, if you want to talk about equity, it is best you talk about the liability, because the residual interest, all right, the residual interest of an asset after its liability has been stated for is equity instrument. So we need to go on and understand what a financial liability is. The reverse of financial asset is the liability. Okay, so that is what. So we say that a financial liability is any liability that is a contractual obligation. That is a contractual obligation one, to deliver cash. All right, so here we are talking about to receive cash. Here we are talking about to deliver cash, right? Or another financial asset to another entity. All right, so either you have the responsibility or the obligation to deliver cash or any other financial asset to another. Secondly, we want to say that it is a contractual right to exchange, right? Contractual right to exchange so same here, exchange financial asset or financial liability with another entity. All right, and potentially under potentially unfavorable condition. If it is favorable, it is an asset. If it is unfavorable, it is a liability. All right. Then, lastly, we say that it is obligation that will be settled All right, that will be settled in the entity's own equity instrument. All right, so that is that. This is not an investment here to be settled in your own equity instrument. Typical examples are we have trade payables, we have debenture loans. So these things we are saying, you see that it fits here, all right? The debenture loans, you have an obligation to pay the money back to deliver cash, all right? Okay, so that is basically that is it. Then we have redeemable preference shares, which is the third one. Investments here in an equity instrument is money that has come into you, being invested into your company as equity. All right. So that is investment. It is an asset in your books. All right. So that is it. Okay. So we have redeemable preference shares. That is really on an unfavorable, because after paying the interest, you will still have to pay the redemption on it. Okay, so that is it. When it comes to financial or equity instrument is just the residual, okay, of the assets after. So we say it is the residual interest. Residual interest. Okay, of financial assets after consideration of financial liability. What we are trying to say is that equity is equal to A minus L. So the A is this side, the L is this side. All right. So that is that. Okay. I mean, if you go ahead, you are talking about your capital structure, your share deals, your capital surplus. All right. So all those things that we are talking about, they are all financial assets. Okay. So that is that. Okay. So now let's quickly move on to the measurement, recognition and measurement of these three. It is tricky for students understanding financial instrument, but I want you to follow me systematically and you'll get it here, because this is where it gets a bit confusing. All right, so we are talking about recognition and measurement. And I'm still going to split the board into three. And I'm going to talk about financial assets here, the recognition and measurement, equity, then financial liability. So far, we know the definition of all these three, and we've known some examples. All right. So let's go ahead and talk about the recognition. All right. The recognition for a financial asset is that simple. The standard says that an entity shall recognize a financial asset in its statement of financial position when. So you recognize when and only when, all right, the entity becomes part of or a party, all right? Let me say a part of or a party that is more legal, a party to the contractual provisions in the instrument. All right? What we are talking about is the financial instrument, in the financial instrument. All right, so the moment you become a party of the contract embodying the financial instrument, then you can recognize it. All right, so that is that. All right, so it's that simple. You just need to know the surroundings of it. Okay, it is very, very important. Very, very important. Where we now go on and talk about the initial measurement and subsequent. Okay. So let's come here. Measurement. And measurement, we have initial measurement. Now, the initial measurement of a financial asset is at fair value. Okay. Fair value. All right, it's at fair value. But there is, before a financial instrument come to play, here there are elements of something we call issue cost or transaction cost. Okay, so the initial measurement is actually at fair value. Okay, and this fair value is likely to be the purchase consideration. All right, the purchase consideration that is paid for the financial asset. Okay, the purchase consideration that you pay to get that financial asset. Because of the concept of issue cost and transaction cost, it's like going out to buy shares. All right, sometimes you have to incur some transaction costs. Sell your shares, you have to incur some transaction costs. All right, so that is it. But the initial measurement is fair value, and remember, it is an asset. All right, so asset is what the direct cost and any other cost incurred. All right, into bringing the thing into its useful state. So therefore, it is at fair value with, adding transaction cost or issue cost. All right, or issue cost. So if you want the value, the initial value of a financial asset, which is going to be the purchase consideration plus the transaction cost, unless the question tells you to treat this finance or the transaction cost or issue cost, unless transaction cost or issue cost listen to me carefully, are supposed to be treated through the P&L, all right? P&L. Now, as to whether you treat it at P&L or not, it's the question that will tell you, all right? The question will tell you. So if you are going to initially recognize the financial asset, it is actually the fair value plus the transaction cost, all right? So that is that. Unless the question tells you that treat that transaction cost aspect or the issue cost aspect through the P&L, all right? So that is that. So it means that the default concept is this bit, all right? That is the default. And in the default, it is the purchase consideration plus the transaction or issue cost, all right? So that one will give you your initial measurement. Unless the question tells you to treat the transaction or the issue cost to the P&L, all right? That is that. So it's that simple. It's that simple. Okay, so that is that. Okay, now let's look at the subsequent measurement of a financial asset, the subsequent measurement of the financial asset. Now, the subsequent measurement of a financial asset is that simple, okay? Is that simple. So subsequently, and here we are talking about where you actually pick the figures into your SOFP, all right? So that is that. Now, the subsequent measurement of a financial asset is fair value through OCI. All right, so normally you will see fair value through OCI. All right, so that is that. Now, what do we mean by this? It means that if you have your initial measurement at fair value with the transaction cost as part of the initial measurement, then any subsequent measurement of it, if you have another valuation of it, any difference will go through the revaluation surplus, okay? So that is what we mean. So you have to revalue the asset at the end of every year, and any difference of positive or negative, so the positive will go to the OCI, all right? So that is that. So normally, if you have, unless the question tells you that the fair value is, or the transaction cost is through the P&L, okay, in that case, any change will go to the P&L. Other than that, we say that all revaluation surpluses that will happen, or subsequent fair value that will give rise to change, a positive change in the revaluation, will go to where? The OCI. Please take a very important note of that. It is very, very, very important. All right. But I mean, when it comes to financial instruments, where the examiner is much interested in, is actually the liability. All right. So we say that with revaluation gain going to the OCI. And that is where you use the default here. All right. So let me just link it here. All right. But if you were meant to treat the transaction cost through P&L, then the subsequent measurement will be fair value through P&L. Okay. So that you will have to go and offset the transaction cost in the P&L. All right. So that is that. Okay. So note that. And if it is a loss, it is automatically going to the P&L. Right. So here, so for here, revaluation gain or loss to P&L. If you use this one and you have a revaluation loss, remember, just like IAS 16, losses go to P&L, unless there was an initial profit seated in the revaluation account for you to offset it. All right, so that is that. Okay, so that is the subsequent and the initial measurement for financial assets. All right, so that is that. Now let's go ahead and look at equity instrument. For all financial assets, the moment you become party to the contractual contract, or whatever you call it, all right, you have to recognize your financial, and this thing cuts across, all right. Become a party to the financial instrument. If you were there as an equity representative, you will also recognize. So as for the recognition, it cuts across. Immediately, you have become a party. If you become a party, then it means that you also have a financial liability, if that is your position in the contractual provisions. All right, so that is that. So I'm going to use the space to talk about the subsequent and the initial measurement. All right, the initial measurement and the subsequent measurement. All right, so for initial measurement for equity instrument. So I mean here it cuts across. All right, it cuts across. So let's look at the initial measurement. For an equity instrument, I mean like purchases of shares in another entity. If you purchase shares in another entity, then what is going to happen is that you are going to measure the your initial thing through fair value through P&L. All right, fair value through P&L. Okay, so take note of that, fair value through P&L. And when we say fair value through P&L, it means that the transaction cost, or issue cost will go to the P&L. All right, so take note of that. It means that the transaction cost will not be included. All right, it will not be included. And this is the default. So unless the question tells you otherwise, this is the default that you have to go by. All right, you have to treat the transaction cost as P&L. All right, so take note of that. So like we said, they will never be included within the initial recognition of the financial instrument. Okay, so that is that. There will be expense in the P&L. Okay. So they will not be included in the financial asset. All right, so that is it. Now, at the end of every year, it will be revalued again. All right, so that is that. I mean, if it is going to go through, then it means that your subsequent measurement will also be fair value through P&L. All right, so that is that. So if it's valued, then any gain or loss will go through the P&L. All right, so that is what you want to know. Okay, but sometimes the question can also tell you that you should recognize the fair value through OCI. So here, if it happens that you have a fair value through OCI, please take note of how the question tells you to do. Okay, then you have to value it fair value through OCI. But the default is this one. It is through P&L. Just like in terms of asset, the default is through OCI. This one. So the default for initial measurement of an asset is to add the transaction cost as part of the asset, included in the asset. All right. But when it comes to the subsequent, it means if you have the default, then you see your subsequent will be fair value through OCI. In the same way here, the default is fair value through P&L. So in your subsequent measurement, it will also be through P&L. Now, if the question restricts you to use the initial measurement as fair value through OCI, then your subsequent measurement will also be fair value through OCI with revaluation gain treated in the OCI. Okay, here, if you are going to go through, it means that the transaction cost will also be capitalized. All right, that is the difference. So you are put into a situation where the transaction cost is to be capitalized, all right, or is to be passed through P&L. So that is that. That is the distinction between OCI and P&L. Okay, so that is that. So this is it for equity instrument. All right, so take note of that. Take note of that. Then we have almighty financial liability, because this is where everything is actually centered. Okay, this is where everything is actually centered. Now, what we are going to do is that we are going to pick it one by one. So the initial measurement, and here it is very tricky. So I need you to concentrate, because examiners always test financial liability. Hardly do you get things of financial assets. It is always a financial liability. Check through all your passports. You'll see that it is all about your financial liability. All right. So what is the initial measurement? What is the initial measurement? So initial measurement, your initial measurement of a financial liability is fair value. Is fair value. All right. Now everything is fair value, fair value, fair value. But what is the definition of the fair value? In the asset here, we said is the purchase consideration. And you have to include the transaction cost. So that was fair value. In the same way, when it comes here, initial measurement is also fair value. It's just that transaction cost should be treated through the P&L. How do we go about this? The fair value here that we are talking about is actually the net proceeds. So we say net proceeds and when we talk about the net proceeds of cash received, net proceeds of cash received. What we are trying to talk about is that your nominal value, the face value of what you've actually issued out. Listen, when we talk about issue of financial liability, it's like the government saying he's selling bonds, all right? So that is what it means. You as an individual, you are going to buy just a paper, all right, and give the price of that paper to the government, all right? So it is the government hearing that issued it out for you to buy, all right? So that is what we mean. Now, if they issue it and you buy, they have an obligation to pay you back the money. So it is a financial liability to them, all right? So it is an entity who issues it that has the liability, all right? And when they issue it, there is a face value to it, okay? And that is the money that they want you to give them, okay? So that is the nominal or face value, all right? Know that. But when we talk about the net proceeds, you know that because, for example, Ghana's situation, our rating is very bad, our credit rating is very bad, we will have to incur more transaction costs in trying to convince people to even buy the bond, all right? So the net proceeds here we are talking about is the nominal value minus any discount, all right? Minus discount. Minus discount. All right, because people may not be buying, we have to probably give a discount. Okay, so that is that. Minus a discount, that is the net proceeds, all right, of cash. Then we have to go ahead and less our issue cost, all right, and less our issue cost. Okay, so the cost of issuing the liability, we have to less it. So issue cost. So if you look carefully, then it means that we have our initial measurement of a financial liability to look this way. So we have the nominal or face value. Let me use face value so that you not be confused with fair value. Face value. Then you have to less what? Discount on the issue, on issue of this. You have to less it. and further go ahead and less issue cost. Okay, so please take very important note of it, because so that will be your initial liability, because this is where your exam is actually centered. All right, because you will need this initial liability to do your subsequent measurement. So if you get this bit wrong, then it means that everything you do subsequently will be wrong. All right, so that is that. So that is the initial measurement. Now let's focus on the financial liability a bit and talk about the subsequent measurement of a liability, financial liability. All right. Now, the subsequent measurement of a financial liability is actually at amortized cost. Amortized cost. It's at amortized cost. All right, so that is the, okay, so that is this. And this amortized cost is for liability that is not held for trading. All right, that is not held for trading. And derivatives that are liabilities. Okay, so, and these things are unlikely to be seen in your FR syllabus. All right, so that is why we are sticking to the amortized. All right, so all financial liabilities are amortized cost, unless, like I said earlier, unless they are liabilities that are held for trading. All right, and these things are hedging instruments and also derivatives. And your syllabus doesn't cover derivatives. Okay, unless you are probably doing FR, all right. CR, sorry. Derivatives that are liability. All right, so the options, swaptions, and all those things that you do under a hedging. All right, so that is that. Okay, so aside these ones, we stick to amortized cost. Okay, and that is that. Okay, now what is amortized cost? The formula for calculating amortized cost, I believe you know. You have your initial value, which is your initial measurement. All right. Your initial measurement. Okay. Then you add your effective interest, the interest that you will be paying, effective interest. Then you less what? Interest paid. So this interest is actually at the implicit or effective rate. All right, so the discount factor or the interest rate factor is the effective rate on it. Then you come here and you talk about the interest paid. All right, and this one is actually the coupon rate. All right. So it is the percentage on the nominal. All right. On the nominal or face value. All right. So this one is the rate on the initial measurement. Okay. So that will be your opening value. Okay. So the effective rate is on this initial, but the payment is on your coupon. Percent on your nominal value. Take note of that, all right? Because remember, if you will have your nominal value here, but you will be lessing what discounts and issue cost. All right. For the initial measurement, so you get your initial liability. Now this one, this bit is what you are seeing here. And on it, you will be applying this effective rate, all right? The opening balances, all right? But this bit, the percentage is actually computed on the nominal. You have to be very careful because they will give you different figures. You have to be very careful. All right, so that is the initial measurements and the subsequent measurements. Let me just talk about some two types of debt instruments, and we will proceed to, deal with some one or two questions. Then probably we will come back and take some issues like preferences and like interest and dividends, and something like a compound instrument, the hybrid ones. All right. So let's go ahead. Let's talk about what we call this deep discount bonds. All right, discount bonds. So they are under like sort of the financial liability. So in a deep discount bond, so I want to talk about deep discount bonds. Discount. They are just examples, all right, that we need to isolate. Okay, then we also have debt instruments. Remember, all these things are financial liability. All right, but just to highlight on some things, what you are supposed to know is that there are some characteristics of a deep discount bond which are under financial liability. All right, so that is that. And like typical that is all right, that is what happens. You have to do a deep discount bond, but nobody is willing to because of your credibility. All right, so we say that it is that one is an instrument that is issued at a significant discount to the nominal. To the nominal. Now, what you will see is that it has huge discount. All right, this discount is so huge. So you see that at the end of the day, it reduces the initial measurement of the line. Now, and we say that it has a coupon rate that is lower than the market rate. These are things that may come for you to state. Okay, so coupon rate is lower, usually, right? Lower than the market rate. All right, yeah. So these are the two things that embodies. And a typical example, the cash flows that surrounds a deep discount bond is what you see here. All right. So the full cost of borrowing this kind of bond is like you have issue cost, You have the discount. You have the discount on the issue. Then the two main payments, all right, which will be your annual interest payment. And at the end of the season, you see that they will pay a premium on redemption. Please, what we mean by the premium here is that, let's say if you borrow 50,000, okay, if you issue a 50,000 bond, all right, it means that for, let's say, 4 years, it means that at the end of the 4 years, after paying interest, if it is 10%, it means that every year you'll be paying 5,000 for 4 years. All right, but at the end of the 4th year, you have to pay the principal. And premium is when you will have to even pay on top of a principal. So, and the deep discount bond always come like that. All right. So what is going to happen is that instead of paying the principal of 50,000, you may be paying like, say, 55,000. The 5,000 here is not the interest, but the full amount that you are paying upon this redemption, meaning that the 5,000 on top is what we call premium, right? These are all costs to a deep discount point. All right, so that is that is what you're supposed to know. Okay, now let's look at debt instrument. It's also the same, but what I want to draw your attention to this one. But before I even come to debt instrument, let me hold on to this and let's talk about preference shares. All right, because they are all. This one receives a fixed dividend, all right? They receive a fixed dividend. Now, in preference shares, we have two types. We have irredeemable, and we have redeemable. Okay. Now, if somebody has irredeemable, it means that the shares have no obligation to receive any payment, all right? Either capital or dividend. Okay, so irredeemables herein are classified as equity instruments. All right, they are classified as so because there is no liability, there is no obligation to be paying this interest. The principal. Sorry, so you'll be paying your interest. I mean, for the payment. So you see that this redemption is never happening. All right. So I mean, just like dividends, you'll be paying something once, you'll be paying, like the way you pay dividends, you'll be paying them. So they are also receiving dividend as if they are equity holders. All right. But because there is no liability, contractual obligation to pay the principal back, just like stated capital or equity instrument, no liability to pay the issue capital out. This one too is the same because it is irredeemable and therefore it is equity. But if it is redeemable, then it means that they will be receiving a fixed cumulative dividend, all right? And at the end, they will also be receiving their full amount that they contributed. So that one will represent a liability. And so it will be a financial liability. All right, so take note of such. Take note of such. Very, very important. Okay, that is it. Now, we have interest and dividends. Okay, we all know that the equity dividends are declared and reported directly in the equity. All right, so it's not P&L item; it's directly in the equity. And the dividends on these instruments are classified as liability and therefore treated as finance cost. Okay, so that is that. That is that. Dividends on these instruments are treated as finance cost. You always see it, interest paid and all those things. Okay, so that is that. So take note of that. And if it is equity hearing, the dividend goes directly into the statement of changes in the equity. All right. But if it is redeemable, we are talking about finance cost. All right. So that is that. That is that. Okay. But the most important aspect is this one. And before you can do this, you need to go through this. It's very, very. All right. We will take some examples. All right. We'll take some examples. So let me see if we have some examples to deal with. All right, so this is what I just mentioned, your opening liability, right? And your finance cost is taken from the effective on your opening liability. The one on your nominal will give you cash payments, all right, which goes to your cash flow. Then you have your closing liability to be presented in your SOFP, right? It's very, very important. And one thing I will have to add is that, let me quickly add that one about a debt instrument. Let me quickly add that one. Is that if you have a debt instrument, such as bonds and redeemable shares, talking about bonds, what we've looked at, and the redeemable. What you are supposed to know is that for those ones, they are categorized under one of the three methods, okay, for their subsequent measurement. You will have fair value through P&L. You have the amortized cost, which you see here, okay. Then you also have fair value through OCR. All right, the default is actually the fair value through P&L, all right? But the thing you should know around this thing is that it will be passing through the amortized cost concept, all right? Unless it passes through the two tests, all right? So you only use amortized cost unless the debt instrument passes the two tests. The test that we are talking about is the business model test. I'm doing this because it can come for you to explain these things, all right? Why you are using the amortized cost is that it has passed through two tests and it's okay. The first one is the business model test. The business model test is such that the entity is actually going to hold on. So they must have what we call the entity. We say the entity must intend to hold on the investment to maturity. So if you issue a bond and somebody buys the bond, to the person who buys the bond, he's investing, all right? If such a person is going to hold his investment to maturity, then it means that it has passed the business model test. Okay, All right. Then we have the contractual cash flow characteristics. That's the second text. Contractual cash flow characteristics. All right. So this test is about the fact that what is going to happen is that the characteristics is that there will be interest payments. Okay, there will be annual interest payments, and there will be principal to be paid back. All right. So if your cash flows are these two that we are talking about, they are solely the principal and the interest. I mean, which of the liabilities will have the principal and the interest? Every bond that you buy will have the principal. And if the person who invested in the entity is going to hold the bond to maturity, then you are going to use the amortized cost. And that is why, even though this one is the default, you will see if everything is going to hold, I mean, to maturity, then it means that you are automatically going to use the amortized cost, regardless of the fair value through P&L. All right, so that is that. That is that. All right, so take notes of these things in the question. Other than that, you will just fair value the debt, and any difference, gain or loss, will go to OCI. But I mean, which examiner will do this? Normally, they want you to go through the difficult stuff. So we will be preparing this table here. All right. So your finance cost is this part. These things are cash flow items. Then what is going to happen is this one will be your closing liability. Okay. So you take this one to SOFP, this one to P&L. These are cash flow items. All right. So let's just look at the illustration, and probably we will talk about the compound instrument. Okay. All right. There are some illustrations. So just take your time and view this, because once we step into the illustration, I will need your input on them. All right. So that is that. Okay. So let's look at some questions. Let's look at this illustration. I will use the solution for explanation. All right. So that is that. So we have James. We have James, and he says that on January 1, James issued a loan note, okay, for 50,000 nominal. It was issued at a discount of 16% of the nominal. Take note of that. And we have issue cost of 2,000. There, what we are going to see here is that the interest of 5% on the nominal value is payable annually in arrears. Then we have the bond must be redeemed on 1st January 2016. All right, 1st January 2016. After 5 years, okay. Then he said at a premium of this. Effective rate is this. So so when you see questions like this, wherever it appears, endeavor to go through the initial measurement. Okay. The initial measurement. The initial measurement. And what is the initial measurement? Remember, it is the net proceeds of cash received minus issue cost. All right. Net proceeds of cash received minus issue cost. And we have here the nominal value, which we have here as 50,000. We are going to go through and less discount. Okay, now discount is what? 16% of the nominal. So 16% of 50,000. Now if you punch 15%, but 16% multiplied by 50,000, you are going to get 8,000. All right, then we less what? Our issue cost. Issue cost is given to us as 2,000, so we less 2,000. What we are going to get as our initial measurement is 40,000. All right, so that is that. What is that? We will go through and do our subsequent measurements. Okay. All right, so what we are going to do is that normally this one is requesting us to prepare for the period to the redemption. All right, but normally you will have to go through and end it at the year the year of your questions requirement. Okay, so because it's this, I want to pull up the amortization that has been done on it so that we can actually move faster on this. All right, so that is your 40,000. So this is your 40,000 that you see here. I don't think this bit is that difficult. So if you follow through the lesson, I don't think you have difficulty in dealing with these things. Okay. All right, so this 40,000 now forms your opening liability for the first year. All right, so you calculate, remember you have 12% and the 12% is calculated on this one. So you divide by this. Payment is 5% on the nominal. All right, so that is what I talked about earlier. This ones will be on the opening balance. This one will be on the face value or nominal value. All right, so when you take that off, this is where you end, and you'll be doing that continuously. But in an exam question, just check the year, all right, that you are supposed to prepare, because you just pick the finance cost of those years and the closing liability of those years. All right, so you go through there and do your amortization table. Okay, so you see, at the end of the term, you are seeing this. Now, what is this? Remember, you had 50,000 to pay, and remember, you are going to pay it at a premium of 4611 as per the question. All right, and that ends you up with 4611, as you see here. All right, so that is that. You can go through it and finish it just to be sure if your answer is right. But I mean, if you know your concept, you don't need to waste time about it. Okay. So that is that. Most of the time, maybe it will be at the second year or just the first year, so that you can pay these figures, right? To represent the figures in your answers. Okay. So now, the last bit I want to show you is in the form of a proof that you see down here. So what is going to happen is that your repayments that you are going to make, all right, so what you will see here is that the capital that you borrowed, all right, you issued out is 50,000. You are going to pay a premium on it, so you are at the end of the day paying this premium. But don't forget that every year you are paying 5% for the 3 years, all right, so that ends you up. If you now take your cash receipt out, you see that all the other payments that you've done are financed. So look at this. You issued something like this. You are paying 4,611 on top. And you see, at the end of the day, these are the amount that you are going to pay. But you actually only receive 40,000. And that is the case of, I think, our country now. And I think we income more and we receive less. All right. So, I mean, it will be well. All right. So that is that. That is that. So that is how financial instrument looks like. It's not that difficult. That should call for any price. So there are so many examples for my good friend Akubila this morning back tie. These are my tripartite guys. You can take your time and go through them. So it's no difficult thing. The important thing is that you should be able to, do your initial measurement and use your initial measurement to do your amortization thing. That is all. There is nothing difficult about this. All right, at all. It's nothing. All right, so you see questions like this. Here you have McGrath, financial liability, nominal value is 10,000. Interest is payable 5% in arrears. When you say you are seeing this payment in arrears, that is the positioning of your amortized table. If you have it in advance, then the positioning of your amortized table must change. All right. So instead of the opening liability, interest, then less payment, you will less the payment, then you calculate the interest on the net of. All right. So this is what I mean. But which financial instrument you needed the money, so why will you even be making advance? So if it is in advance, just like the way you do this, opening liability, payment, then you less the payment from the liability, you get your subtotal, then you come and calculate your interest. You get the net of to your SOF. So that is that. But hardly will you see that sincerely. Okay, so they said that McGrath trades in financial liability in the short term, and at 31st December, market rate has risen to 10%. All right. So you need to go through and do your initial and subsequent measurement. Okay, so that is what you see here. That is what you see here. So the key bit you are supposed to see is that you need to understand if this one is a debt, all right, that is having a characteristics that we spoke about. Are you going to use amortized cost or are you going to use fair value through P&L? All right. So what you see here is that what are the repayments? You see, you have to pass through the business model test and the contractual cash flow test. All right. The business model test is that the people will not, break, or they will hold the investment to an end, and the cash flow is that it's just principal and interest. Now, if you watch this, it says that it is traded in a short term, something you should know. It's a very short term. So it should be measured at fair value through P&L. Okay. Should be measured at fair value through P&L. Okay, so note that. Should be measured at fair value through P&L. Okay, so that is that. And if you are going to measure fair value to, so that is the normal thing that you do. So we say that liability should be measured at fair value at the reporting. Assuming fair value of that liability cannot be observed from the market, then it is calculated by using discounted. So what you are going to do here is to take the cash flow. All right. And how do you derive this 5,000? Okay. You go through your initial measurement. Go through your initial measurement, and that is what you see. This interest payment that you see is 5% times. So that is the interest. Okay, so you go through your interest to end up this. So what is going to happen is that you now have to do this measurement. You take 10,000. This is the new value. You have this. And so you have to debit your liability and credit your profit and loss. This is the case where the thing is going to be under fair value through P&L, just because it is a short term. All right, it's a short term. The question gave it to you here, short term. So be careful. Like I said, there are three. You have to use fair value through P&L, which is the default one. All right, which is the default one. Then we have amortized cost. The only way you meet, and listen, I told you that for some of the tricks that you know is that it is a traded financial liability. It's either a derivative or it's a traded financial liability. So you see that number one, it is a short term. It's a short term. Where is it? Coming from here in the short term. That is what they are doing. And they trade it. So if it is something that they trade in, remember, let me stress on that again so that you don't forget. Now, what we said was that we singled out some debt instruments. And we said that for debt instruments, our measurement subsequently is fair value through P&L. 2, we have amortized cost. And 3, we have fair value through OCI. Now, this is the default, all right? But you use this when it passes the business model and the contractual cash flow characteristics. All right, the business model here is that the person who is investing in the money you sold or you issued a bond to will hold it to maturity. All right, to maturity. And these things are long term. Then we said that the contractual is that you have 2 types of cash flow, the principal and the interest. All right, so I mean, the interest will run for the long-term periods, and at the end of it, you pay the principal. Now, remember, these debts, right, we are talking about are those that are traded, all right, and they are derivatives. We have traded financial liability and derivatives. These things are traded. Like I said earlier, they are the options, swaptions, hedges, all those things that you use to hedge. All right, so if the question gives you a clue here that they trade in financial liability, then it means that we need to go through and apply our default. If you remember when I was doing financial instrument, I stated that unless it is a traded financial liability. If that is the case, then what you are going to go through and do is to use fair value through P&L. All right. And please, if your liability reduces, it is a gain. Remember that. Remember, this is from our first lecture. All right. The framework when we were doing it. So what you are going to find out is that he has 5% to be paying on this amount. Okay. So that is the money that you pay. So in your amortization table thereof, that is what you are going to go by. All right. So that is why you see there. So the 5 is actually the 5% on the 10 million that you see. And that is what you are going to go by. All right. So depending on the period, you see we have 2011 here. I think there is an error that needs to be checked here in terms of the years. All right. Okay, so if that is the case here, then it means that you pick the first year that they will be paying the interest. Okay, so that is what is going to happen. So this is the interest. And if you had an active market, then fine. This one, if you don't have an active market, you have to now use the present value of the future cash flow. All right, so the present value of the future cash flow, you have this. And at the end, you are paying the 10 million with the same interest at the redemption date. All right. So that is it. So that is why you have this to have this. At the end of the day, when you PV it, you are going to. So this one is to elaborate to you when you have to know which of these methods to use. All right. Be very careful. Be very, very careful about it. All right. So when you PV them, it means that you have a liability of 10 million that has turned to this. And remember, if that is the case, you are going to go through and credit your P&L, reducing your liability. All right. So that is that. That is that. It's very, very important. There are so many questions you can go through and deal with. I want to quickly talk about the compound then to end today's class on financial instrument. Okay. So please take your time, go through it, and be very, 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 very. Now, a contract instrument, a compound instrument, sorry. Compound instrument. It's actually a hybrid, right? It's a hybrid of equity instruments. That is why in the definition I did and or. All right. So equity instruments and financial liability. All right. So that is the case. Equity instruments and a financial liability. It has the characteristics of both. All right. Okay. So what you realize is that example, we have a convertible loan. All right. So in it, you can see that the lender will have an option, okay, to convert it. Okay. So that is that. And see, the things you should know about these ones are that it is repayable at the lender's option. So whoever invested has the option to keep it as a liability, but also to convert it into equity. But the number of shares we are talking about as to whether they will agree to convert it or not. If you are converting it to equity, you need to have the number of shares. Okay, but the number of shares are agreed. Number of shares to be granted for equity is agreed at inception. They are agreed at inception. All right. So as at the time you are signing the contract, that is when you agree. All right. That is when you agree. Okay. So you don't wait before. All right. So that is that. That is that. Okay. So we say that because of this, the lender will accept rate of interest below market rate. Rate of interest below the market rate for non-convertible instruments. All right, not for non-convertible instruments. All right, so I mean, that is it. The lender will accept market rate of interest that is below the market rate for non-convertible. So that is that. What you are supposed to know is that inside these convertibles are equity components and liability component. That is the main thing that you should know concerning these things. Now, how are you going to derive all these things from it? Now, so we say that, let me open this new board and explain it further. All right. So it has two angles to it. It will have a liability component and it will also have an equity component. Okay, so how do you derive these things? So now, in terms of your initial measurements, you are going to go through and carry out some amortization, a PV formatted table. So you see that like the one that we did on debt instruments, okay? So the same thing that is going to happen when you were doing the fair value through P&L, the example that we just did. So that is what is going to happen. You will have your years, say 1, 2, 3, all right? Sorry, 1, 2, 3 years. And the years will be stated in the question, how long it will take for the principal to be redeemed, all right? So that is what you have. But probably you go through and do some description. All right, so say interest, then redemption. All right. And don't forget, if you are doing the redemption, you have to pay the interest of that same year. So plus, if there is any premium on top that you have to pay, they will all come in here. Then you have the cash flow. Okay. So if it is interest, you state if it is 5,000, the interest of 5,000, then you use a discount factor to PV them. Now, this discount factor we are talking about is the effective interest rate, all right? Then you have your present values, okay? So at the end of the day, you sum up your present values. Once you sum them up, remember it is your liability, all right? It is your liability, okay? Then you check it with the proceeds that you actually receive. All right, the difference here will now be your equity. All right, so that is how you go through with your initial measurement. All right, for these convertibles, that is how you go through. So that you, when we pick up a question, you will see, you go through that and you actually see the difference therein. Okay, so that is that. That is that. Okay, so let's talk about the subsequent measurement. All right, then we can actually take. But so in a, as the liability component, we all know what we look for. All right, the liability component, what we are looking for our subsequently, what we are looking for is the finance cost. All right, then we need our current liability, of course. Then we need our NCL. So we are going to get these ones by going through the amortized cost concept. All right, so that is what is going to happen. Now here, what we'll be looking for is that it's an equity and you'll be looking for the share capital, all right, component of it, and also the share premium. Something on top of how much they normally sell shares. So these are what we'll be looking for. And you go through this to find the difference, okay? Then Subsequently, you'll be looking for these. These are from your amortized table, and these ones to be seen so clearly. All right. Okay, so let's take a question for the figures so that at least it makes sense to us. Okay, so let's go back to our so that it makes some sense to us. So yeah, let's look at this illustration. Okay. So what you see here is that Downsword Limited issued 50,000. So take note of the 50,000 for a 3-year convertible bond at par. There were no issue costs. Hallelujah. The coupon rate is 10% payable in arrears at the end of each year. The bond is redeemable. It's redeemable. It's redeemable. And the fact that it's redeemable gives you an example of debt instrument. All right. Note that. At par on 1st January 2014. Oh, well, so if you are going to count this, it means that the thing is from January 2011, and we also is for 3 years. So it means we pay interest for 11, 12, 13. We are done with the payment plan. It's just that the principal is going to be redeemed a year after. So we need to note that. Okay. All right. So this is the year it is going to be redeemed. All right. I said that bondholders opt for conversion. Okay. So that is that. And the term of conversion is 25 cents for each equity shares for 1 Ghana cedi owed. Okay, so you need to note all these things now because it is out of these kind of statements that you get your share premium. All right. The bonds are issued as by similar entities without any conversion at 15%. You know what we said is 15%. These ones gives you your effective rates. All right, your effective rates. Okay, so that is that. So we already know that the nominal is what, 50,000 or 50 million, sorry. All right, so what we are going to go through and do for our initial measurement, remember the cash flows are 1 to end the principal. That one amortizes. All right, so the cash flow, this thing is the PV discount factor, is actually from the formula 1 plus 1 over 1 plus R raised to the power n. That is what. So, or 1 plus R raised to the power minus n. The n is the number of years. So we are 1, 2, 3, and 4. All right. We step into 4 because the payment is actually made on 1st January, which is the 4th year. But if the question says they pay it at the end of the 3rd year, here should be what, 55 million. Be careful. And so you go through this, you do your PVs as we said, and you end up with 44,000. But remember, they actually received 50,000 because there was no issue cost, there was no discount on it. All right, so that is it. So you see that there is a difference between this bit and this bit, and that is this one. So this becomes our equity. So for our initial measurement, this is what you do for those that are convertibles. All right, you go through this and the money that they receive, assuming there were issue costs and stuff, you will actually check the proceeds that they receive, the net proceeds that they receive. So here would have been minus issue cost and what discount, if any. All right, so that is that. So you go through here. Now, my interest here to do this thing is quite simple. My interest is that you have to do your subsequent measurement. That is where I am concerned. So let me show you how the subsequent measurement looks like. Because the subsequent measurement for a liability like this, which is having interest and principal, and it's also for this long time. It is not a traded derivative or a traded instrument that you see. Okay. Once it is in the financial market for a traded as a traded instrument, please use fair value through P&L by what? PVing the interest. Okay. PV the interest and the principal. All right. Then if the PV that you get is actually, so it's just like doing this thing that you've seen. But those ones are not convertibles. All right. So therefore, these differences that you have in those instances, okay, so you see that your liability is actually lower than this, and therefore you are going to credit your P&L and debit the liability. Okay, so please get those things upset in your mind. All right, so that is that. So what I want to go through and show you is how you go about your subsequent measurement, which this one did not show for. Okay, so let me just pull up a question to you that has it. Okay, so that is this illustration for you. Okay. Let's look at this illustration. And if it's not there, I'll show you how you are supposed to go through with your self premium concept for your subsequent measurement. All right, so that is that. I'll show you how it's done. Now, before I do this, let me just go to the board and show you in a simple example. Then we will use this illustration to end the class. All right, so I'm going to pose a little question here, and you will use it for all right, so the question is that, let me use myself. Answer company issues convertible loan that pays, say, interest of 2% per annum in arrears. All right, let me say market rate, say 8%. And this one is for equivalent debts without conversion. Without conversion options, all right. The loan that I'm going for is 5 million, and it will be repayable in say 3 years, after 3 years. All right. Or I can convert it to equity. All right. Now, most of the time you may be given the discount factor. So let's do discount factors for this 8%. And please, it is the effective rate discount that we use. So normally, the question will confuse you by giving you some PVs or the discount factors of other interest, probably the nominal value, all right, this one. So they'll give you for 2% and 8%. You are not concerned with the nominal, you are concerned with the effective. Please take note of that. These things confuse students a lot. What you use to PV is the effective rate not the nominal. I repeat, not the nominal, all right? So please take note of that. Because sometimes you have students confusing which ways to use, and they'll go and use the nominal. Once again, I say it is the effective rate on the market, all right? So let's say the discount factors for 8% for year one. I have a PV table that says this year one will be 0.926, year two, I have it here as 0.857, year three is 0.794. All right. If this thing is not given, you have to go through and use 1 plus 1 over 1 plus r raised to the power n. All right, to get this. Okay. So that is that. Now, if we are going to go through and deal with this, our initial measurement for a convertible, because since it's convertible, we need to know the equity component of it. All right. So what we are going to do and do is that we have our year 1, 2, 3. All right. Check if the question adds 4 years to it, because after 3 years means that it's at the end of the year, or if they don't give you emphatic dates, maybe probably a date in the next year. All right. So we are talking about being redeemed after the 3 years. Okay. So probably the last day, all right, of the 3rd year. Unlike the other question we dealt with, they told you that it will be done in the 4th year. So this one you can end in the 3rd year. So what we are going to do is that we have our cash flows. So we will do the interest. What payments are we talking about when it comes to the cash flow? We are using, this is where you use your nominal, 2% times the money that was taken, which is what? 5 million. So you are going to go through and see that if you do 2% is what? 100,000. All right, so let me just put 0, 0 here. So you have 100,000. Please, if you fail to watch this part, this is how we derived our 100,000. Okay, because of the zeros that are there, let me keep it. This is how we derived it. So every year will be, and mind you, so this is what is going to happen. At this last year, you are going to do the 5,000 plus the 100,000 interest. All right, so that is what is going on. You now have your discount factors. You pick 0.926, 0.857, 0.794. All right. If you do the PVs here, you are going to end up with I think it's 93. You have here 86. And you have here 4,049. All right. Now, if you sum this thing together, you are ending up with 4,228. Okay. So that is 4,228. So that is what you have. Now, the difference here from the 5,000 that you actually received here. So this is your liability. All right. And you have your equity. That's the difference. Which is what? I have here 772 as equity. All right. So that is that. Now, subsequently, if I want to measure these things, then I need to go through my subsequent measurement here. I need to go through my subsequent measurement. For the liability is, as you know, we are 1, 2, 3. Opening liability displayed 4,228. Then we come, it's in arrears, so we charge our interest. Remember, interest is 8%. Effective interest, all right? So we will do it on that. So we have, I think, 338. Then the interest payment, which is 2% on the nominal. So you have 2% on nominal, which will give me 100. And my closing balance for this year will be 4466. All right, so that is that. And you continue like that, 4466. You do your interest of 8%. You are ending up with 357. So you pay your 100 out and you are ending up with 4723. The 4723 continues with interest. I think you have here 377. You pay off your 100, then you end up with 5,000. All right, so this. All right, so that is how it balances up. So that is it. Okay, so we will be picking these as our finance cost, and these are figures that will be going into our liability. All right, so please note that. Note that. It's very, very important. Okay, so you need to really take your time and go through this. All right, now this bit is the equity component. Now you check, all right, for yourself. I didn't give a structure to this. You check for yourself. If all your shares, you have to compare these things to the financial statement at the price at which shares are issued, okay? So if you have, say, stated capital in your company, maybe one CD at 1 CD per share, and you have, let's say, 50,000. This one that is coming in, you need to check. If it is coming at 1.2 CDs, then it means that you have to treat the one, okay, one out of it, two stated capital. Any the 0.2 that is on it will go to share premium. I think I should be able to get you a question that befits this explanation. I think I should have such. Okay. So this question is here, you split it as you see, you split it. Then I think this one will show us the share premium concept that we are talking about. All right, so let's look at this question and close the class with it. All right, so this question, so let's go through this. Okay, so we have Louisa issuing 50,000 for 3 years, convertible for that part. There were no issue cost. Coupon is 10%, payable in arrears. Bond is redeemable at par at this date, so you need to check here to here. But they told you it's what, 3 years. It means you need to add the 4th year, paying the principal only. All right, only. Unlike the other example I just did, where there is no date for this thing. All right, so bondholders opt for conversion in the form of shares. The term is that they will convert at, see, 25 cents. Okay, so let's replace this with pesos. Okay, let's replace this with pesos. All right, so I mean, for equity share, for every 1 Ghana, 1 Ghana cedi. So this is what we have. And we have the bond issued by similar entity without conversion. So this one becomes our effective. And it says how will this be on that. All right, so let's go through. And so you need to do your PV for the interest. All right, that you'll be paying annually. And it is 10% on this. All right, these are the payments that you are making annually. So please, I think you should not confuse yourself with the effective interest and the nominal interest. Okay, so be careful. So the initial measurement, you are using the nominal payment. Okay, the payment. All right, so number one, our step one is to go through and split it. Okay, how do we do that? By going through and using the cash flow. Remember, cash flow and is the principal and interest. So you see here, you go through this. You go through this. All right. It's the beginning of the 4th year. So it hasn't ended for you to use 4 here as your factor. So it's 3 years. All right. I think I need to check the initial example if there was an error in that. Now, so you go through this and you find your difference. So this one becomes your equity component. All right. So that is that. Now, you need to go through and do amortization table for this bit. All right, which we've done so far, and you know how to go around it. So that is what is being done here. All right, but my focus is on the equity. Okay, so the equity, you see the conversion of the bond, if it is to be converted, then it means that you have equity and you have this. So at the end of the day, this is what you have. Now watch this. The conversion are 2 pesos. So let's always give it 25 pesos equity for every 1 share. Therefore, if the bond is to be converted, all right, if the bond is to be converted, then it means that you have 10 million shares because you are converting. What you are going to do is that you are going to go through with your 15 million at 2, because they are actually going to do, the terms are 2.25 and 25 cents. So 2, that is where it is coming from. The 2 is what you have here, and will be issued at a nominal of 25 million because of this 25 cents. So you have 100 million shares. Because you already have this, all right, so I think I need to check this because they already have 50 million. Okay, it should be in shares, all right, at 1 cedi. So it should be shares here. All right, so what you are going to do is that at the end of the day, you have 25 million because you are multiplying 25 cents by 100 million. Okay, so you have 100 million multiplied by the 25 cents. All right, so you have 25 million. Let me just write for you to get this. Listen, this one is 2.25 cents, and I said you can make these things pesos. So it means that our shares are 1 Ghana cedi. All right, already that we have. So what is going to happen is that you have 15 million shares. For every 2, it is going to make our number of shares 100 million. Now, if you are going to go for 25, 0.25 pesos multiplied by 100 million shares will give you 25 million. All right, so that is what you see here. Okay, then it means that if that is when we are converting, all right, so please note that that is when we are converting. If that is the case, then it means that this bit that we have, all right, is going to have its splits as you see. So this 25 billion is what our equity out of this, because we converted it. So we will have our 55,701, 708.1. If we now take our 25 million out, it means that we should be having 30,708. This now becomes our share premium. All right. So you see, if you see the entry here, so we have the initial, what you see here, for conversion. That is what you see. Other equity component, that is what you see. And your share capital with your share premium to balance up the journalization that you have done. All right, so that is when it's going to go through conversion. So you have to split them. So if it is converted, then this is what you have going forth. All right, so that is that. That is that. So if not, then it means that you have these ones just seated as your other equity components. Okay, that is the difference that you had on top here. Yeah, so the other equity component stays here. All right, so that is that. But if it is going to be converted, then this is how the conversion is done. Okay, because these were the conversion terms. All right, so that is that. You need to know this. Solve more examples and you will be fine. So that brings us to the end of our financial instrument class. It's a bit confusing sometimes, but with what we have done, all you need to know is that you've gone through the definition as we did. So all you need to go through is to understand your definitions. So let me just do a summary shot here. Let me just do a summary of what we've done today over here. So what we've talked about is that we have financial instruments. And our focus today was on IFRS 9. And we said that there is a financial asset to it, there is an equity instrument to it, then there is financial liability component of it. All right. And we went through to give examples, you need to go through it. And we said that we have initial measurement, all right, it's fair value, including what? Transaction cost, all right, as the default, okay? But know that sometimes the transaction cost can be meant to pass through P&L. If that is the case, then we go on with our subsequent measure. If it was included, then it is fair value through OCI, with any revaluation gain going to where? OCI. But if transaction costs were meant to be passed through P&L, then our subsequent measurement will be fair value through P&L, all right, with any gain or loss on transaction fair valuation going through the P&L. Here we said that the default is fair value through P&L, all right? So that one will mean that if that is the case, then our subsequent measurement will also pass through fair value through P&L with any gain or loss going through P&L. Sometimes here too, you may be restricted to fair value through OCI. In that case, it means your subsequent measurement will also be fair value through OCI. The most important bit is that equity liability is actually initial cost. Remember, it is what we did the nominal, you less discount, then you less issue cost. So that is your initial measurement. All right, so that is what you go through to do. Okay, then the subsequent measurement for a financial instrument, other than, listen, and this is where the key is, other than those that are traded okay, on short-term basis on the financial market, and derivative. Other than those ones, you will use subsequent measurement as amortized cost. And how do you go through and do your amortized cost? You set up your table, okay, you have your year, you have your cash flow, which is your initial liability, all right, coming from this one. You do interest on it, all right, then the payment, which is the implicit or the coupon rate, sorry, which is the coupon rate on the nominal, all right, so you less those ones. Then you get your balance carried out, and that one will go to your SOFP, your interest and your finance cost, all right, so please take very, very important note of that. Then we actually talked about debt instruments, all right. We went to talk about debt instruments. And here we talked about redeemable preference shares. All right, so we said that for the debt instruments and redeemable preference shares, we have subsequent, the measurement there, you will have to go through the test to see if you are going to use amortized cost. So we said the default is fair value through what? P&L. We have amortized cost, but you will only use the amortized cost when it passes through the business model test and the contractual cash flow characteristics. All right. If the principal is the principal and the interest. All right. Business model is the person who has invested will hold it to maturity. And be careful, all right, because that is where you need to know you have to use this default, or that is this default. All right. So if it is traded, okay, then it means that it can be pulled off at any time. Okay, so be careful. If it is traded, like derivatives, they have hedgings, and so they can be pulled off at any time. You may not hold a thing to its maturity. Okay, these two things must be met before you can use the amortized concept. All right, so if not, then you go through and do fair value through P&L. How do you do that? You just PV the interest, all right, and the principal. Okay, then you compare it to the nominal or the net that you have here. And what you are going to go through and do is that it's if there is a decrease in the amount, then since it's a liability, a decrease is a gain, and therefore you are going to debit the liability and credit your P&L. Please know that. Now, there is another third option, which is fair value through OCI. Hardly will you see happen. Right. Then we went forward to talk about convertibles. All right, so what you are supposed to know under convertibles is that it has two sides to it. It can be converted, and therefore it has equity and liability. So once you PV the cash flows, which is the interest, the nominal interest payment, that's the nominal, please note that, and the principal, you will see that the value will not be equal to the nominal. The difference thereof is your equity component. All right. So if the question goes forth to tell you that there hasn't been any conversion, then you keep quiet and you treat the difference as your other equity component. Then you go ahead and also do your amortization table for your subsequent measurement for the liability part. All right. Okay. But if you are going to convert it, then it means that what you are going to do is that technically the liability will not exist because they are coming in the form of equity. All right. So the difference, the money that you get for your initial measurement, all right. So what you had after you did the PV from here, the total that you had, okay, which being the nominal. Okay, when we did it was 50,000, and the equity component of, I think it was 7,000. So the addition will now be split into, and be careful, it is the nominal and the equity component. All right, so be careful about that. Okay, so what you're going to do is that you need to now split that figure into share premium and stated capital. All right. It's a premium because what you will be receiving will be on top of what you normally receive as your stated capital. So you go through and do the component of your stated capital. In this case, where we did this scenario, let me see. In this case, where we did this scenario, they were buying it at 25 pesos for every 1 Ghana cedi share. And then we'll give our stated capital that they are coming in with. So it's 25 pesos. You multiply it by the new number of ordinary shares that will be coming in. That one will give you 25 million as we pay. The remaining is something that is on top of the share. So if they go ahead to convert, this is how you go around it. All right, so go through it, learn more about it, and you will be fine. All right, so God bless you. I think the next time we meet, I'm going to tackle IAS 12, IFRS 15, then IAS 21, and we are done with our standard. Yeah? There's EPS, IAS 33. We'll look at it. All right, so God bless you and have a great day.